Good morning, everyone, and thank you for joining us at What and Where to Invest 2022. My name is Wei Ren, Senior Portfolio Manager at iFast, and today I'd like to talk about some of the key investment themes that you should watch in 2022 and how you should position your portfolios for the year ahead. Now, 2021 has been a very eventful year. The year was once again dominated by the COVID-19 pandemic, as new waves of Delta infections swept across the world and also forced countries to implement lockdowns and social distancing measures. And more recently, the discovery of Omicron added to fears that the ongoing economic recovery would be derailed. But despite the setbacks in our fight against COVID-19, global equities continued to hit record highs in 2021, thanks to high vaccination rates as well as unprecedented stimulus measures. But not all markets did equally well in 2021. As we can see very clearly from this chart, the market rally was actually quite uneven across the world. On one hand, we have developed markets like the US and Europe leading the way in 2021 thanks to their high vaccination rates and generous stimulus measures. And on the other hand, we have markets like China that ended 2021 with very steep losses. And China in particular was on a different path compared to the rest of the world. China persisted with its COVID-0 strategy, and they also avoided the use of large-scale stimulus like the US. And more importantly, China cracked down on its technology firms. And that has left many businesses and investors very fearful over the future of China's tech sector. And some of them are even wondering whether China's equity market is even investable in the first place. So it should come as no surprise that China ended 2021 as one of the worst performing equity markets. So 2021, quite an eventful year, but with COVID-19 now persisting into its third year. Getting our asset allocation decisions right in 2022 will also not be easy. So over the next few slides, I'll be highlighting several key investment themes that you should look out for this year, their investment implications, and also how you should position your portfolios for the year ahead. Now, it's impossible to talk about 2022 without first talking about inflation. The Federal Reserve has for some time characterized last year's higher inflation to be a transitory issue. But after several months of higher prices, there is increasing evidence that inflation appears to be sticking around and could last well into 2022. And it was only in December last year when the Fed finally stopped using the word transitory to describe inflation. And in fact, they are now projecting 3 interest rate hikes in 2022 to help bring down inflation. So rate hikes this year are more or less a foregone conclusion. And this also means that 2022 is likely going to be quite a tricky year for bond investors because fixed income as an asset class, it tends to be sensitive to interest rate movements and they can be vulnerable to price declines when interest rates move up. What about equities? Will the Fed rate hikes this year cause a huge market crash? Well, not necessarily, because if you look back in history, there is evidence that equity markets can continue to do well even in a rising interest rate environment. Now, for example, if you look at the rate hike cycle from 2004 to 2006, the Fed hiked rates for 17 consecutive times during this period. But you can also see that over these 3 years, the S&P 500 still managed to deliver very favorable returns. In fact, they delivered an annualized return of more than 10%. And similarly, if you look at the rate hike cycle from 2016 to 2018, the S&P 500 also managed to deliver an annualized return of more than 9% during this period. So there is no need for you to panic. There is no need for you to reduce your equity exposure to prepare for Fed rate hikes this year, because equity markets can have the potential to do well even in a rising interest rate environment. So what are the investment implications for our portfolios? At the asset class level, we do think that equities are perhaps the better place to be in, and we recommend investors to be overweight equities relative to bonds for 2022. In a rising interest rate environment, fixed income assets will likely be more vulnerable, especially the longer dated bonds. And on top of that, in terms of valuations, equities are also more attractive relative to fixed income. If you look within the equity space, the US equity market is probably the only market that is considered to be very expensive. But outside of the US, there are still plenty of opportunities within the equity space. Now, fixed income is a different story. We are of the opinion that valuations in the fixed income space are starting to get expensive across the board. And even though there are still selected opportunities within fixed income, they offer very limited value to investors. And given that we're quite likely to see a continued economic recovery in 2022, then this environment should also be supportive of equity performance this year. Within equities, we are underweight the US, and that's largely because US equities, they look extremely expensive at this point, both in terms of absolute valuations and also relative to other markets. Earnings growth is likely to have peaked in the third quarter last year, and with the market already pricing in a lot of positives, that also means that our downside risk for US equities have also increased. Now, to be very clear, we're not expecting a huge sell-off in US equities in 2022. But what we're trying to say is that investors should expect lower returns from US equities this year. And given that there are other more attractive regions to play the continued economic recovery, we recommend investors to underweight the US equity markets in their portfolios. Europe could be a more attractive market to play the recovery compared to the US, given its higher rates of vaccination and more supportive policies relative to the US. And despite the strong performance of European equities in 2021, the valuations of Europe, it's still at reasonable level, especially when compared to the S&P 500. And on top of that, European equities, they have long been seen as a value market that is heavily weighted to banks and the other old economy industries. So a continued global economic recovery could be supportive of European equities. Japan is also starting to look interesting. In fact, Japan is one of our most favored markets for 2022. We think it has the potential to play catch-up with its global peers this year. The Japanese equity market delivered quite a disappointing performance in 2021, and it lagged behind the US and Europe by quite a wide margin. And that's largely because of its slow vaccine rollout in 2021. But the situation has changed. Japan's vaccination rate has since accelerated sharply, and it has now overtaken even the US and the UK. And this paves the way for a more sustained economic reopening and a recovery of Japan's domestic consumer spending. Policy in Japan is also likely to be supportive. The stimulus package that was recently announced by the government should be a tailwind for the economy this year. And Japan does not have an inflation problem. If you look at this chart, the core inflation in the US is currently hovering at about 5% as of November 2021. But look at Japan. Japan's core inflation was actually in negative territory over the past few months. And this also means that the risk of Japan tightening its monetary policy is almost non-existent at this point. Most importantly, the market valuations of Japanese equities remain attractive, again when you compare it to the US equity market. In short, we think that the stars are well aligned for Japanese equities in 2022, so we recommend investors to be overweight Japan in their portfolios. Outside of developed markets, there is also another market that we are particularly bullish on, and that's China. While China is unlikely to engage in large-scale policy easing in 2022, we believe that its growth slowdown is currently at a point that policymakers can no longer ignore. So moving forward, we can expect to see some policy fine-tuning and incremental loosening by the Chinese government. In fact, the PBOC has already delivered some supportive policy fine-tuning for the property sector by ensuring that the healthier developers have continued access to bank lending and mortgage approvals. The central bank has also been cutting its reserve requirement ratio in order to support the slowing economy. With China now focusing on stabilizing the economy and keeping its growth within a reasonable range in 2022, we expect China to roll out more supportive policies in the year ahead. We also expect to see an easing of regulatory pressures on China's tech sector. Now, the big tech companies, they have had a very challenging year in 2021, but these companies, they have been increasingly aligning themselves with government goals and investing in key strategic areas like cloud computing and semiconductors. And with the Chinese government now focusing on economic stability, and also 2022 being a politically sensitive year for President Xi Jinping, we think that drastic changes to the regulatory environment is a scenario that is quite unlikely. So we think regulatory pressures could ease this year, and China's technology sector could see a strong turnaround in 2022. And most importantly, the valuations of China's equity market are at rock bottom levels. Investors have already priced in quite a fair amount of negative news. So from a valuation perspective, we do think that the Chinese equity market is very attractive at this point. Now, what about fixed income? How should bond investors position their fixed income portfolios in a year ahead? With rate hikes coming in 2022, we think that global investment-grade bonds, they are likely going to be very vulnerable, especially the developed market government bonds, given that they are very sensitive to interest rate movements and their valuations are also quite expensive as well. High-yield bonds offer higher yields compared to investment-grade bonds, and they are, of course, more attractive on a relative basis. But having said that, the valuations of global high-yield bonds are also quite excessive at this point, which is why we also keep our underweight position in global high-yield bonds. We are also underweight the emerging market bond segment, which is also offering quite limited value at this point. But more importantly, emerging market bonds come with high duration, and this makes them very vulnerable to price declines when interest rates eventually increase. So which other fixed income segments should you invest your money in? Now, we think investors should go for short duration bonds, which tends to be less sensitive to interest rate movements. And another segment that we're particularly bullish on is Asian high-yield bonds. After the significant correction in 2021 due to China's crackdown on property developers, the Asian high-yield segment is currently offering investors a yield of more than 10%, which is the highest level in the fixed income space right now. The credit spreads of Asian high-yield bonds have also widened very substantially, suggesting that attractive value is starting to emerge. In fact, if you look at the current credit spreads of Asian high-yield bonds, they seem to suggest a mass default across the Chinese property sector, which is a scenario that we think is highly unlikely, as credit fundamentals in general have improved in the sector. Of course, we do not rule out further defaults in the sector, especially amongst the smaller property developers, but we do believe that default risk should be manageable in the year ahead. On the policy front, we think that the worst of the crackdown is probably behind us, as the Chinese government has recently shifted its policy stance to more pro-growth policies. The government has already delivered some supportive policy fine-tuning for the property sector by ensuring that the healthier developers have continued access to bank lending and mortgage approvals. So we maintain our overweight position in Asian high-yield bonds. We think that a lot of negatives have already been priced in, and the current valuations of Asian high-yield bonds more than compensate for the risk that investors are taking in this sector. And here's a quick summary of what I've shared today. For 2022, we think that investors should be overweight equities relative to bonds. Within equities, we are overweight Japan, as we think that Japan has the potential to play catch-up with its global peers this year. We are also particularly bullish on China, given its rock-bottom valuations and the recent shift in policy to a more pro-growth stance by the Chinese government. Within fixed income, we think investors should go for short-duration bonds, and we also think that Asian high-yield bonds are offering attractive value. But of course, at this point, the emergence of Omicron has added one additional layer of uncertainty to our asset allocation decisions. It is still too early to draw any conclusions given the lack of information about Omicron, but we stick to what we know when making asset allocation decisions. And what we do know about Omicron is that governments have acted very fast and aggressively to contain the latest variant. When Omicron was first discovered, many countries imposed travel bans on Southern Africa within a single day. And this was important because it bought time for health systems to prepare for the new variant. The situation was very different for Delta. countries took weeks to impose travel bans after Delta was first detected. And by the time Delta has been identified by the WHO as a variant of concern, it had already spread to many parts of the world. Vaccines, of course, still remain our primary defense against the virus. And on this front, there is some good news. Most developed economies have high vaccination rates. The vaccine makers have also said that they will be able to tweak their vaccines to fight Omicron. And there are also early indications that Omicron may be less deadly than initially thought. Now, it is still too early to make any conclusions, but important to still monitor how the situation evolves. But for now, based on what we know, we remain cautiously optimistic on the global outlook. If there is one lesson that we can all learn from Omicron, it is that our fight with COVID-19 is far from over. And this means that market volatility is likely going to remain high, at least in the short term, and that the best way to navigate this uncertain environment is to have a diversified investment portfolio. And if you're not sure how to build a diversified portfolio, then our FSM managed portfolios is certainly an option that you can consider investing in. It helps you to build, monitor, and rebalance your portfolios on your behalf. So it is designed for easy and effortless investing without the stress, especially if you don't have the time to manage your own investment portfolios. And most importantly, you don't need to commit a huge sum of money. All you need is just $500 a month, and you can gain access to a diversified portfolio of not just international equities, but international bonds as well. And with that, I've come to the end of my presentation today. We still have a lot of programs lined up for the rest of the day, so please stay tuned. And right now, I'll hand the time back to Gladys.